Happy Sunday and good morning. This is Jeff Scott, and this is my top-down review. Had some technical difficulties, not sure why. I'm now down to my third machine trying to use Snagit on it to get the video to work. There must have been an update that doesn't like my sound or something. Let's see. I titled today, Will U.S. Markets Catch COVID for President Trump? You know, it felt kind of downright bearish on Friday until you actually looked at the whole week. And it was a great week. I mean, I made a lot of money on the week. I'm sure you did as well. I gave back some on Friday. Interestingly, take a look at the Russell on Friday, super strong. So there was a clear expansion of breadth during the week. But big cap tech seems to take it on the chin whenever there's any run for the hills. And that hit me on Friday as well. As always, just my email address, if you want to reach out to me, is hgsidoc@gmail.com, and my name is Jeffrey Scott. This session is for education purposes only. Any recommendations are in the spirit of education, not investment advice. I am a doctor, not a broker. I am independent. I pay for the tools that I use. Trading involves risk, and you alone are solely responsible for any decisions you make. I'm not going to go much into this slide. I do it every week. I have spent a lot of money and a lot of time learning from some very smart people. Many of the folks who I would attribute my success to are on this screen. And whomever you want to learn from, find smart people, get educated, and then develop your own style of training. I call mine Be Your Own Guru. What I need on my desert isle, I have lots of programs. I have so many programs I buy and I forget that I should go to Software Trading Technology Anonymous. But I need my TradeStation or Thinkorswim. You'll see me use it today. I use a number of indicator sets with it. I need those. And then I spend most of my time when I'm not real-time need in HGSI, supplemented with EdgeRater, and Q and Dr. K are some of the tools that I use in TradeStation or Thinkorswim. From time to time, I'll do some webinars where I'll bring them on, various guests. And it's important that you know I am never paid by any vendor when you buy something that I suggest or use. Any affiliate fee offered to me is passed to the purchaser as a discount. I am an unpaid volunteer, and this should be considered what it is, just education. The website for HGSI software, of which I have no financial interest, is highgrowthstock.com. If you go and the free 30-day trial, you can get what it says, 30 days without even giving a credit card. And if you go under investing strategies, you can see my name and many others and hundreds of videos that are done on a weekly basis. Okay, stock patterns are cyclical. And this is an important pattern to me because I don't care if you're looking at tick, minute, daily, weekly, monthly, quarterly. I don't care if you're looking at a stock, an index, an industry, a sector, frankly, a future on a currency. They all go through this pattern over and over again. Where are we today? Gosh, on Friday, it felt like the Russell was breaking out, and the Russell's been the laggard, and maybe the Russell is breaking out, and at the same time, it felt like the Qs were falling over. So it's hard for me to believe that we're going to have that much of a disconnect going into the fourth quarter. The fourth quarter is usually a pretty strong quarter, especially in a presidential election year. But I do think at the minimum there's uncertainty going into this week. I think if Monday morning we awake to Trump being on a ventilator, heaven forbid, or doing poorly, I think the markets are going to sell off in response. If, on the other hand, we see him walking out of the hospital and going to the White House via Marine One, then the markets will probably rally. Since I have no insight into that, neither do most of you, I think we have to consider this market to be uncertain at best. If it's uncertain, then you want to be in raising cash, smaller position, and selling premium. I've done that a lot over the last month or so, where I have been uncertain. And now I'm not all uncertain. I do have some long and some shorts, and we'll talk about as we go. Now, if you look at Friday, I mentioned that even though the majors were down, there was good breadth for the week. And you can look at things like real estate, almost everything was up. Utilities, almost everything was up. Industrials look good. Financials of all things look good. Materials look good. So some of the defensive plays and some of the other leaders are still good. Staples, technology, discretionary, and that big cap tech really hurt on the technology side. Let's go into Thinkorswim and actually take a look at some of these major markets. Make sure I'm in the right place, that it's daily. I hate when I do this and afterwards I review it and say, darn it, I did it on the weekly instead, which is fine, but not if I'm telling you I'm looking at daily. So we're on daily, and let's go to maximize sell. So this is just a very simple chart. I like to look at it to understand the markets. This is 1 year, and this is futures. The futures will be different than the cash markets. They'll be less gappy, of course. And they may or may not be the same pattern on the cash. And we'll look at the cash indexes at some point, as we always do. Couple of points here. We are up on the year on the E-mini futures. If you look at the last 12 months to date, if you look at the high of the year occurred back here on this date, which was September 2nd. The low of the date was March 23rd. On January 1st, it was in this area here. So you can see we're up a little bit on the year on the S&P 500. If you look at this chart, you'll see the 17-day is dropped below the 50. The 200 is still rising, 50 well above the 200. If I had to be a bull or a bear here, I see that the indexes are sort of coalescing around the 50-day moving average. Now, what had once been support now looks like it might be turning into resistance. So before I got excited to be long in this market, I'd like to see a break above that 50 and, more importantly, a close above the 50. I'm not bearish per se that the market has to go down, but I'm a little bit disappointed that the futures have fallen below the 50. If I look at the NASDAQ futures, a similar picture. Up a lot on the year. Prior high in February was here. We're way above that high. And the high on the year, as you could see, was also September 2nd, which probably for you and me and others was the high watermark of my portfolio of the year. And you could see March 23rd was the low. And you notice how good John Person's indicator is. That's the blue indicator here. He went into a buy the day after the low of the year. I mean, when you see that on an automatic printed indicator, that's a pretty cool thing. And also notice that John's indicator went, and this is a free indicator on Thinkorswim, by the way, the PPS, that it went short on February 21st and did not fire long or short again until after the bottom. That's a pretty remarkable finish. You'll notice it also gave a short signal there and now is in a long. So looking at the NASDAQ, similar picture, except it did start above the 50, closed below the 50 on Friday. I need to see it bounce soon. It looks like it bounced off the 17. I'd like to see it get back above the 50 quickly, and I'd like to see the 17 trade above the 50. And not, then more weakness might be expected. And again, things that are support on the way up often turn into resistance on the way down. The Dow futures, a couple of differences here. One difference is the high on the Dow futures, also in February 13th, has not been taken back out. If we get the intraday high up here, the close, high close on the year, we have not gotten there. So that is negative. Its low also was on March 23rd. It's funny, these days that are the most horrible days in the market, the days you think it can't get any worse, are usually correct. They don't get any worse, and that's where the market reverses. But many of us are probably selling here because we're concerned about what's to come. Now, interestingly, although the Dow's been a laggard compared to the NASDAQ and the S&P on the year, it did close above its 50. The 17 did drop below. And look at the bottoming tail on this. In fact, you could argue not much bottoming tail in the NASDAQ futures, but a bottoming tail also exists on the Dow that could be somewhat bullish feeling. The Russell, similar to the Dow in some ways, has not taken out its high of the year. It's nowhere close. It also this high of the year, unlike the other three indexes, is not its all-time high. The big difference is if you look at the far right edge, you got a hammer with a positive close above the 50 on the Russell. So you had a positive day there. So the strength certainly over the last 1, 2, 3, 4, 5, 6, 7, 8 days has been in the Russell futures. The VIX, it tried to run on Friday, but it didn't even run enough to trigger a buy signal, and it closed halfway down. So I don't consider that a very bullish candle. However, I do look at the VIX being in a resting phase, not only above its prior resting phase, which would be bearish on the market, but it closed above its major market indexes. So we'll have to see what goes on with the VIX. And then if one looks at the dollar after a big rally, the dollar has pulled back into its indexes. One would expect a bounce here, as you might expect some support from the 17 and the 50-day moving average. But this did pull back this week. So that's my view on the futures, and we'll see if the view is the same as we go into the cash indexes in a few moments. The weekly charts just tell you how we've done this year, last couple of years, and you see great uptrends, certainly in the E-minis and the NASDAQ, not so much in the Dow, and certainly a sideways movement in the Russell, in the VIX, and the dollar we already spoke about. Now, if I look at things underneath, and I do this analysis in minutes on a daily basis, just flipping through the various programs I use for speed. On the 10-year and the 30-year bonds, interest rates ticked up this week. Very narrow range, but I called it they trickled higher. AD lines on both the small caps and the large caps picked up. In fact, the large caps are back towards all-time highs on their AD lines. Now, the indexes have lagged, but you can see that the larger cap index is outperforming the small cap. That said, the small cap was strong this week. If I look at the NYSE, you could see the big move up in the AD lines, and the only thing that tilted down this week, not surprising, would be the TLT with the rise, albeit small, in rates. Breadth also rebounded. Stocks above the 200 in the 40% range, stocks above the 40 also in the 40%, both up off their prior. And look at how much we moved on those above the 40. And in fact, if you look at the T2121 in Warden, the 3-month or 12-week new high, new low, massive move up, almost to the point of getting near overbought. Notice the word I said, almost to the point. The daily McClellan, I guess the big thing here is the oscillator crossed over the midline, which was better than getting a zero line reject, which would have been bearish here. Certainly not in an extreme. And the three things I look for, as taught by John Person, are extremes, divergences, and zero line rejects. No new signals, but we did see for weeks a divergence that ultimately played out. Buckets. So imagine if you could very quickly look at every stock in the S&P 1500 and put their Bollinger Bands on and tell me where those stocks fell within the Bollinger Bands. On the right, that pie chart shows you that a little bit more than half the stocks in the S&P 1500 are now above the midline of their Bollinger Band. I'd have to consider that somewhat bullish, because if one goes back and looks over the last couple of weeks, there were more red than green. In fact, if one looks back maybe 7 or 8 days ago, you would have seen 30% of the stocks were below their Bollinger Bands, and that's totally been worked off as the breadth has improved. Now, Hindenburg omens are these interesting signals. We saw one on February 24th. That was a pretty good signal on the NYSE. But these are signals that occur before major market tops, and 1 out of 4 will predict a major fall. No major fall since the middle of the last century has occurred without at least one Hindenburg omen prior to that fall. So I monitor them, but I would not expect them to occur again until we get to a new high. I chart these on HGSI, but I also run them in EdgeRater, which is very quick. Hit a button, get the answer. Market tone in EdgeRater, it's mixed. This is choppy, where it's red, green, blue, red, green, and yellow. I can't tell my colors. This is bullish when it's all green. This is ugly when it's mostly red. We're chopped to bullish here. So even though Friday was such a tough day and we've got the concerns about the president's health, the market did not end on a weak note, at least from a longer term perspective. In fact, even the sector strength improved as we're now bullish or neutral across the sectors. Speaking of sectors, if I look at Sagar's awesome Q tools, I can see here that as of end of day Friday, 8 out of 3 sectors were 8 out of 11, 8 versus 3 were positive on Friday. Over the last 2 days, 9 out of 11. And if you look at the last week, 10 out of 11 sectors were positive. So the lone sector that was negative on the week was energy. Big shocker. You can see here 1 week, 2 weeks, 3 weeks, 3 weeks ago, or a month ago, all sectors were negative. And you could see how badly over the last month energy has performed. Interestingly, up one of the highest on Friday. If we look across the industry groups on a 1, 2, and 5 day window, one could see how the industries have fared. Green are positive, red negative. Gives you an idea of real time what AD lines are. And boy, you want to know how helpful this tool is? Imagine the market's up big at 2 o'clock one day, and you notice there's more red on the industries and on the stocks. Tells you the market's probably going to reverse. And how about if the market's down, but you see a lot of green? It tells you the market's probably going to reverse. I find these 3 gauges to be incredibly useful. Now, Sagar, I know you sometimes watch my videos. Can we have a 2-week and a 1 month as well? Because I think that would be even more interesting to see. Now, within Sagar's tools, I can do top-down analysis, real-time, on the fly, using Excel spreadsheets and his awesome macros. Now, the problem here, just to be fair, is you got to have Thomson Reuters as a data source. If we look at end of day Friday, healthcare, which had been strong up until a while ago, then weakened, strengthened again. So healthcare was the leading group over 10 days, one of the leading groups over 10 days, 2 days, and was the leader on Friday. Energy, which has been in the toilet except for occasional bumps, is strong again. Well, that's very interesting. Very interesting. Communication services, financials, that's coming off the bottom. Now, real estate, utilities, industrials, and actually, check that. I just realized that this didn't update. Hold on 1 second. Let me fix that. All right, sorry about that. I updated it in one place, but when I saved it, it saved the older version. So I knew it was wrong because real estate were on the top. So as you can see, this is a great example of market rotation. Healthcare, communications, which were near the top on that sheet, have rotated towards the bottom. What's sitting on top are financials, which have been strong over the last couple of weeks and months, which is interesting. Real estate, which has come on of late, and materials. So that's clear evidence of market rotation away from discretionary, healthcare, and information technology. Now, what will be interesting to see is whether or not over the next few days that rotates back to healthcare and technology. Seeing financials up is actually a positive, I think, if one considers the impact on the market. So I decided to dive down on financials because there's a big group. I hit these gears and I brought up all the different groups, industry groups within financials. Now this is based upon the S&P 1500. Thrift and mortgages, asset management, real estate services, regional banks coming up near the top again. So then I decided to go through the top 1, 2, 3, 4, 5, or 6, I think 5. I highlighted them and I hit the peer analysis and I brought up a sheet of the potential stocks and I ended up with a couple of choices which we'll talk about later. But I'm able real time during the day to do mostly fundamental and price movement based top-down analysis. Canaries in the coal mine, neutral. I mean, it's above the 50, struggling at the area in the 17, 8-day exponential in the 17, above the 50 and above the 200. These red lines here are chandelier stops, and I'd like to see it take out the chandelier before I get too excited. You notice during the entire run-up here, it did not have any violation of its chandelier. Know your news and earnings. I first thought it was a light news week, but really you got FOMC meeting minutes. Will anybody expect anything except saying we're going to support the economy as long as needed? Maybe some call out about need for stimulus, and then jobless claims. So there's no such thing as a light week in this market. There is a light week on earnings unless, of course, you own one of these stocks. So large cap tech led the NASDAQ lower on Friday as unemployment and Trump's COVID test increased concerns. Of note, the Russell was up over half a percent despite other broad losses. The S&P Dow snapped 4-week losing streaks, and the NASDAQ composite performed comparably with a 1.5% gain. The real winner on the week with a 4.4% gain was the Russell 2000. The president's hospitalization after market close and then the conspiracy theories about his current condition likely will weigh on the markets as he goes through the critical period of his illness. If you think about COVID, you have a flu-like syndrome, which isn't the big problem. Your body may get a hyperimmune state where it starts to attack organs such as the lung and also have a risk of blood clots and other problems. Hence why it's worse in older people who have a more difficult time with those challenges. So that critical period is probably now, although no one really knows when he first started his infection. This also raises question on the campaign, as well as calls out his team's lack of social distancing and use of face masks. Now, seasonality begins to improve in a couple of weeks. Historically, the fourth quarter in the fourth year of the presidential cycle sees a bottom in early to mid-October, followed by a rally into year's ends. Although the number of economic reports is light this week, one might expect some interest in the FOMC and jobless claims. And as we approach next quarter's earnings releases, we will have a light week of earnings. I have tried to protect my portfolio with a mixed long and short approach. I've also used some options on contras, puts on Qs, triple Qs, spiders, and diamonds on very short-term trades. I ended up with quarter four, as you could see here, up 2.1 million on a 1.4 million base, or about a 150% return. We should expect some news and event-driven volatility through the election and perhaps longer if we do not have a final result. If there is a Biden victory, we might see some added volatility as we take long-term profits prior to the new tax plan of the left. This might lead to individual stock volatility, perhaps greater than market volatility, as the money is likely to come right back in, as where else would you put it considering a near zero rate environment. I believe it's still time to be cautious. The market probably reacts one way or the other short term based on the impact of COVID on the president. One notes, despite this, the Russell did finish higher on Friday, and at some point the market recovered nearly all of its overnight losses by lunch before selling off late in the day. I can only imagine what would have happened if the hospitalization was announced before the market closed. Again, sorry about my mess up a little bit on those industry groups. But all's well that ends well, and we caught it. Very quickly, let's just jump into TradeStation before it kicks out on me because I do too much with it. And let's look at the major market indexes. Again, I'm still with the futures. And as people follow me know, I very quickly, every day I look at about 6 things. Number 1, green and red arrows. Are we in a buy or a sell from the John Person PPS? We are in a buy. Number 2, color of the paint bars. Green means I could be long or holding, I should not be short. Red means I should be short or holding, I should not be long. And blue is confused or no answer. So I've got a long on the daily, sell on the weekly, long on the monthly. Last week we were in a sell on the daily, so short term we had weakened. Perhaps now we're starting to strengthen. The green paint bar, blue, green. Again, better than last week. This here I've not used much yet from a market calls. I'm testing out some Laguerre RSI, but I have noted on individual stocks, it is amazing at calling tops and bottoms. These dots here, which have gone away, are when you have MACD divergence. You'd get MACD divergence when you have higher highs, but not higher highs on the MACD histogram. I look down here at the weekly bongo. As long as it's green, I feel like we're in an intermediate to longer term uptrend, and I'm looking at the middle dot. I look at the high jump. I know when I get to the high jump over that dashed line or at about 100% that the markets always pull back. Markets always pull back. Now the problem is they could go on a couple of days before they pull back, but when you see 100, expect a pullback. Why? Because it's telling you that over the last year, that's the most extended that the stock has been. And why is it the most extended? Because it reverses afterwards. Here's the Laguerre RSI, still I would call experimental on this chart. The NASDAQ futures. Red bar, that's the big difference here. And similarly to the Dow futures, get the NASDAQ futures up to 100% on the high jump, and the next bar it reverses. The Dow futures, buy in green, and its high watermark was back here. Look, I created this oscillator where I went from plus 100 to minus 100. The basic concept came from Ian Woodward. This high jump has worked for 20 years. There's no reason to expect it not to work anymore. And the Russell, now in a buy signal as well. So clearly one has to say the markets look better than they did last week. And no surprise, except for Friday, it was a very, very bullish week. The dollar, I said, weakened some. Let's take a look at the USD. And you can see it has a new sell signal, but it's blue and it's a buy on the weekly and a sell on the monthly. Interesting how it's the exact opposite of the major indexes, and you could see the Laguerre and the PPS are sells. All right, enough with futures. Let's go to the indexes. So I'm a top-down guy. What that means is I spend most of my time, and obviously the first 25 minutes of this call so far, looking at the market from a top-down perspective. And then when I don't screw up with the charts, I look at the industry groups, and if I'm long the market, I want to buy stocks in the leading industry groups. Now, on the weekend, I go through the top 10 leading industry groups to build a watch list, but then I look at hundreds, and this weekend, the number of stock charts that I looked at to come up with my final buy list was over 700 stocks. So I do both a top-down and a bottoms-up on the weekend. But during the week, it's predominantly a top-down approach. You saw the returns that I get doing that. So this is not a one-year phenomenon for me. And I find that Hgsi is the best tool in the market, even with the Q-Tools availability, for doing that top-down approach. So I go into major markets analyst groups, or market analyst groups, go to Major Markets Plus, and I have 28 groups. You probably do not. Why do I have 28 groups? Because I added the FANGs, FNGS, and I added two IBD related, Innovator IBD ETF Fund, the 50, and the breakouts, the bout. And then I hit the warehouse view, and let's just pull this down to 28 for right now. And then I look at top-down view, which looks at price and volume. And then I rank them from top to bottom. So 1 week performance. The leader on the week was small caps. 5% on the 600 and 4.4% on the Russell 2000. Notice the sea of green here under the 5-day. It was a very strong week unless you're oil, TLT, gas, and commodities. It wasn't nearly as strong of a Friday. If we look at where the S&P 500 is, it is in the middle. Now very quickly, let me open up a couple of sheets. I hope I don't live to regret this. One thing that you can, that's okay, we're done with TradeStation. Yeah, I've got a really big radar screen that sometimes TradeStation doesn't seem to love right now. So I want to open up the GPA. So within Hgsi is this awesome tool. It's called the Group Performance Analysis. And you could choose whatever groups that you want to look at. And then you could set it up to tell you start and stop dates. And then you can try and understand what's leading the market or failing by how your groups perform. Now, the first thing is this is run from last Friday to this Friday, end of day to end of day. It assumes I buy $1,000 worth of each stock. I exclude indexes, and then there's some rounding. First thing you notice, is there more black or is there more red? Yes, there's much more red. Excuse me, much more black. So that means it was a very strong market. Now, the S&P 500, for example, was up 1.5% on the week. Now, how does that compare with growth? I have the IBD 50s up 1.54. Okay, so it's about the same. I have the weekend review was up 3.79. That's pretty phenomenal. I have, I'm looking for a Market Smith. It's probably right in front of my face. And the Market Smith 250 was up 2.89. So I know right away that growth outperformed. Now I have a mostly growth portfolio, but as I said, I have a long short portfolio. So sometimes this isn't the greatest way of looking. I'm showing 37 wins, 20 losses, 2.54%. What's more important to me, what were my buys? Because these are the stocks that I may have rotated in on the week. And you could see my buy watch list last week was pretty smart. It was 33 wins and 8 losses, or 5%, for a 5% gain. And then my filtered buys, which I take down even further, were up 6%. So I had a good week. I hope you had a good week as well. Now, the other thing is to understand what the market did is I'm going to pull up my warehouse view, all securities. Yeah, let's look at all securities. This is a tool in EdgeRater. It's one of my favorite things is I save, let me show you how I do it because I haven't, well, I'll show you how I do it before we're done today if I remember. I save a picture of the market every Sunday. That picture contains all the fundamental and price elements on that day in Hgsi. Therefore, I can go back and I could choose the date of the report. So I looked at a report, which was a Hgsi database on 9/27, and I asked the question, since this was last weekend, from Saturday to Saturday, how was performance based upon the fundamentals at the close of the day, business day on Friday? So you see some graphs here. Earnings per share group, relative strength rank, and group rank combined, each one 0 to 99. So you have up to 297 potential points. Across the bottom is your ERG. Across the top is your percentage return. So you could see that first thing is this week every number here is positive. Last week it was negative. And it looks like it was pretty flat until you got to the high ERG stocks that took off. Here it shows performance versus EPS rank. The best was the high earnings per share. The best was a high relative strength and high group rank. Interestingly, there was some bounces as stocks that were distributing on the prior Friday performed almost as good as those that were accumulating. So again, a good week for high ERG or growth stocks. Now let's take a look at some of my favorite components that I like to review on a weekend or frankly daily basis. So I'm going to open up two charts. Okay, I'm going to make sure that under tools I have checked link multiple chart windows. I'm going to change this one to my favorite of the week daily chart. And now I'm going to start going through the major indexes. Since I'm not caring about fundamentals, I am going to close the fundamental data window. We're going to start here with the S&P 500. So this is the cash markets. So I try and look at the markets each week with both a bullish and a bearish view. And as taught by Ian, I try to come up with 3 different scenarios. Now, the weekly bongo is green. That is bullish. Above that, you see a lot of white space. We'll have to go back a long ways. And you notice how these red buttons fired up here as we went into the February sell-off. These were the Hindenburg omens telling me that the market was likely to have a major sell-off. Here they have just a small sell-off. This red line here represents the 100% retracement of the February to March swoon. We broke on the S&P above it, and we broke right down below it. Now we seem to have stalled out at that prior resistance. So if looking at this chart and how I trade, I'm a little bit concerned that this is going to be substantial resistance. We failed at it here. We failed at it here. What is support on the way up, the 50, is also sitting here as well, often becomes resistance, but we closed right above it. So what is my 3-road scenario here? You can see that was on Thursday, Friday, we closed below the 50. Road number 1 is Trump comes out of the hospital sometime Sunday. Everybody says he's great. The world is happy again, and the market breaks through and goes and tests new highs. That would be wonderful. That's not what I expect. The 3rd road scenario, the really bad one, is he's on a ventilator on Monday morning, and I think at minimum we're going to test that 200-day moving average, which is down here, which corresponds to the 76% of the prior move. And nothing says that we can't continue to drop if we have a sitting president having a health issue within a month of his pending election or loss for a second term. What's most likely to happen is for us to continue in this chop. And that means what's most likely is that we probably bounce around in here. Now, at some point, we probably will break out of that range. So there it is. High road scenario is Trump is great. The news is good. He comes out Sunday night and says, I'm feeling better going home. And then I think the futures trade up and the market goes higher. The low road scenario, he goes on a ventilator and we start worrying about his death and the transfer of power. It also means that the Supreme Court nomination process may have some challenges. And then the middle of the road scenario is, and we've been in this box of chop really going back to early September. So we could just stay within that box. So that's how I'm prepping for the market. I think breaking out to new highs is not my expectation. All right. So that is the S&P. Let's look at the Dow Jones Industrials. Notice the chandelier stop, ran right into it and paused. It's above the 50, so that's better. It's a break above that. I'll be very optimistic. I think that it has a similar story as the S&P as far as where it's going. The Russell also closing above the 50. Mobile breakout from a squeeze on Thursday, pocket pivot and a person buy signal. If that was a stock, I'd probably be looking at buying it. Notice that the bongo turned red over the last month, or last several weeks, as the Russell sold off before it's reversed. I expect that to change to green this week, knowing how it's calculated since I was involved in creating it. And then the NASDAQ composite. The cash looks a lot better than the futures, doesn't it? You got a bit of a hammer, pulled down to the 50 and held. So if I wanted to be bullish, and believe me, those who know me that I'm more of a bull than a bear. So I really want to be bullish. If I want to be bullish, I can say this. There's my line in the sand. I have not closed below that line in 1, 2, 3, 4, 5 trading days. That line is pretty much where the 50-day simple moving average is. As long as I stay above that on the NASDAQ, then I've held support and the sideways or moving up is at play. I like the fact that we broke above the 50, retested it, and then broke above our chandelier stop. And this here cannot be considered a very bearish day despite being down because of the bottoming tail stopping at the 50-day moving average. So I think we are clearly at a place where the market could go either way. If you're an IBD 50 fan, here's a managed ETF. It ran up to its chandelier stop and stopped and pulled back, sitting right on the 50-day moving average. Again, not what you really want to see if you're bullish, but it hasn't given up yet. If I look at the momentum breakouts, it looks worse, but it stopped about the same price on the 50. It had a red candle high this week and pulled back. Again, does this look strong? No. The question to me isn't whether it's strong or not, it's whether or not we're breaking down or we have a chance to go sideways and potentially break to new highs. And the FANG here looks actually similar to before. This managed ETF is above its chandelier. It's above the, here's the chandelier stop. Here's the 8-day, 17, 15, 200. It's actually above its major moving averages. Again, I'd have to be more bullish than bearish. If I look at the dollar, dollar maintains, oops, that's the bonds, my bad. The dollar had a mild blip up and has pulled back. If it holds above these moving averages, I expect it to go higher. If it breaks below the 50, then we'll probably retest the lows and that'll be good for metals. The VIX, as we said, it's not come down to the same areas it was resting back here, but it's got below its chandelier, below its PSAR dot, above its moving averages. I'd say it's still pretty neutral. And then gold, not doing much. It's below its 50. I probably wouldn't be doing much trading with it unless it broke back above its 50. For right now, it seems to be in a little trading range. Gold miners, similar, and then silver, similar. And the hard thing for me to do anything with is oil, although energy did bounce last week. It's hard to see it there. That's my assessment of the markets. Now I go to industry groups, warehouse view, and I want to look at 2-day force up. I have 64. 2-day force down, I have 20. So short term, that shows strength in the market. What I don't like to see, being a growth stock investor, is to see biotech, semiconductors, app software, communication, e-commerce, specialty pharma, infrastructure, semis, IT services, payments, and telecom, many of which are my typical growth stock, to be in the red here, because that means short term those groups are weak. Long term, I've got 21 week groups and I've got 71. So this was a clear changing of the guard last week, where bullish momentum in the industry groups far outweighed what we saw on Friday. Let's take a look at the 2-day ups. And one of my calls from last week, several were in that first group. So let's see how they did. You can see this group, which we called out last week on the same analysis, was up 16%. Change to industry group, end phase. Well, I believe I showed it to you here last week. I told you I had a position in it. It's had a mobile breakout from a squeeze and a kahuna. This here is the industry group. Person buy signals long. The weekly Pongo turned green. The high jump is neutral. And this was one of the stocks I was looking at buying more, and it broke out nicely. So this is a very profitable trade that I currently have. I am still long end phase. Jinx Solar, shame on me. I've been saying I've been afraid to go long because it's already moved a lot for 2 weeks. That was a mistake. I should have bought some Jinx Solar. I actually had some in an older account, but not enough to matter, and I should have been buying it on this breakout. I was concerned about the high jump, and one of the problems with all measures of extension is things continue to get more extended. Solar Edge broke out again. Plug Power perhaps setting up. That's the top of the group. Sun Power about to take out its prior highs. And I looked at Canadian Solar last week and thought this was the one to buy instead of Jinx. And this one did fine as well. High jump is starting to be an issue. So I hope you bought end phase with me because it certainly did well. Home store product stores changed index groups. Bed Bath & Beyond, surprising earnings. Probably not too late to get in if you like this sort of thing. I have a tendency not to buy things after they gap away, but you could lose the Bible gap up rules. Set your stop kind of here below the gap, or the bottom of the gap up day. I'm looking at this next quarterly earnings, which 171% growth. That's kind of interesting. Lots of demand for Bed Bath & Beyond. Home Depot, this is one of my favorite setups. Why is it a favorite setup? Because doing this. And why is that such a good setup? Because I know when to buy it. I buy it when it breaks above this line, and I set my stop right below this line. And what is this thing doing? It's getting closer and closer together. So what does that mean? It means that I'm going to be able to have a very tight, reasonable stop on an expensive stock if I get it close to the breakout point. So I like that pattern, but I wait for it to break out. It's been going sideways since August. It may go sideways to January for all I know. I don't go below the oil, gas, and services. Haven't seen that up here for a while. I think it's driven by this. And, I don't know enough about lithium to say anything except that it's breaking out. It's a rare earth metal. It's required for the electric cars. This is a Canadian company. Obviously, it's broken out and doing well. I think it's more a lithium play than it is an oil gas play. And look at the volume on Friday, 27 million. Something to look at. I get nervous when I see a stock whose volume used to be 500,000, 800,000, 800,000, 400,000, 2 million. Now it's 4 million. Volume picked up 7 million, and now here it's 27 million. I think back of the old Plug Powers and others that had big runs and then came back to earth. So I'd be careful with this. High jump at the top, but lithium is something that we know from Elon Musk is necessary for Tesla and others. Schlumberger, it made the list because it had a positive day on Friday, but I'm not even going to talk about it. REITs, who would think? Several of my top stocks were REITs this week. REITs are a lot of different companies. EQR is residential REITs. Well, I could see more people renting over time. But boy, this stock has been beat up because a lot of people haven't been paying the rent. Good volume came in on Friday. It's in a downtrend, 4.3% dividend. Prologis, they rent some of the large distribution warehouses. They're all over the country. High close doji on the weekly, breaking out. Remember what I said, the kind of pattern I like? What did it do on Friday? It broke out. Where would I set my stop? Probably right below the low of this bar. Prologis pays 2.2% dividends, got good earnings per share growth. And the big companies that have the big distribution warehouses, probably paying their bills. Retail, shopping centers. Someday they'll become doctors' offices, healthcare clinics, lifestyle, workout places. Right now they're just empty. I have a hard time buying this, but somebody must know something. 8.1% dividend is interesting. And yeah, it's gone nowhere. It's better than a bond paying 8% with some growth. I don't know, I have a hard time. Sun Communities, old people places. These showed up all over my list. Good growth, dividends, and breakouts. Avalon Bay, residential apartments. Well Tower, I believe healthcare related. Senior housing, again, not above the 200. I like the others better. Equinix. You could just read over here, data centers. I like these. This one's way too expensive for me. These look good too. Extra space storage, good earnings per share growth, dividends. If I'm staying in apartments that are too small, then I probably need a storage unit. So I like the story on REITs. Electrical power equipment. No, I don't like GE, so I'm going to blow right through that one. But Eaton Corporation, same pattern, pullback, hasn't broken out. I like to see it get above the chandelier stop, but it had a mobile breakout from a squeeze, person buy, pocket pivot, in a kahuna. So we just talk about philosophy. There are some people I know that would say, I'm going to buy this maybe if it pulls back and touches the 50-day moving average. That would be one approach. How about my approach is to say, nah, because if I do that, how do I know it's not going to do this and continue falling? How do I know it's not going to pull back up to that same point of resistance and fail and come back? Of course, you didn't lose money on that trade. And again, a lot of my stocks are going sideways for quite some period of time. So if I was to trade Eaton Corp, I would put a buy stop right above the high of the day and the high of the chandelier. Now, 105 down to, that's probably about where I put my sell stop. And I would not take this buy until the stock took out the high of the prior day and took out the chandelier stop. Why? Because how do I know it's not going to stay in this trading range? Just my philosophy of trading, and the person who I did that for knows who they are. Blink, I talked about this back here. I talked about it again back here. Still looks interesting. It's a high-risk speculative startup type play. Generac, boy, oh boy, talk about good picks. I know some of you bought this when I told you to buy it back here. And it was funny because it was, I think my buy point was like $105, and it gapped up the next day. This goes back to my message about the last one. If I told you to buy it at $105, I guess if you left your buy on, and this is, when I talk about this person, it's one of my neighbors, and I've been teaching her a little bit. So she knows I mean this well. If you set I had to go above the high to buy it. If I said I was going to buy it when it came down and touched that second line, I never would have been in it. So this has been a great performer. It's a gift that keeps on giving. My target's closer to 220. I'm still long Generac. How do I get my returns? I buy good stocks and I hold them and capture as much of the gain as possible. I'm not trading quickly in and out of them. Banks. What the heck? Banks. Yeah, banks. They don't look great on charts. Sideways move. I like to find one that's broken a little bit above the 200. Capital One, Bible gap up. Well, it doesn't count because it was below 200, doesn't it? PNC. It's not above the 200. It pays a 4% dividend. It's one of the mid-majors in my mind. It had a big day, took out its prior stop. I don't have a problem with PNC. I did like this one better because it took out its 200-day moving average. So Fifth Third, mobile breakout from a squeeze, a new person buy signal, pocket pivots, and a kahuna. I like Fifth Third, and you can always look at an ETF for regional banks. This is KRE, and it doesn't look any better than the banks, and it pays a 3.8% dividend, but it should respond if the group continues to go up without as much individual stock risk. Consumer finance, we saw on the top down from Q that this was a strong group. Look at Square, $171. Boy, it's an expensive stop. Cup handle breakout could be interesting here. I don't like the fundamentals, but obviously I've blown it because I haven't bought this all the way up. Green dot, big move on Friday, probably too much of a move because my stop would have to be too far away, but it's in a strong group, and when I see multiple kahunas in a row prior to a breakout, I pay attention to that. Discover breaking out above the 200, that's at a much more reasonable buy point. Capital One just sticking its nose above the 200 as we saw with Fifth Third Bank. LE Financial, that looks interesting as well. Now the downside is they've all gone a long way. All right. Sorry for all the noise. I've got a call coming in a few minutes, so I keep getting reminders. All right. Continuing on, specialty apparel. Burlington Stores, sideways and breaking out over a trading range. Now, here's its prior highs. It's not there yet. This is where it's reversed multiple times in the past. I'd be aware of that. But a mobile breakout with a squeeze, then a breakout, pocket pivot and kahuna. Gap, high base. Looks like it's ready to run again. I have some gap. Foot Locker, pullback. I mean, there's a lot of interesting stocks here in this group as well. American Eagle Outfitters that look like they're ready to run. Abercrombie & Fitch, another one. L Brands. And these things were all in the toilet, and now they're all starting to perform. Stocks get better before you think they would. Airlines, I have really tough, I don't know. Do I think they're going to be higher in 2 years? Yes. Do I think it's time for that to buy them? I don't know. My friend TG buys all these little moves. I'm not that good. I'm not that fast. I like to wait till they break above the 200 and retest before I'm willing to be in there. So as I look through, none of them are meeting that criteria. Aircraft parts, Boeing. Are you ready to buy Boeing? Lots of blue down here, so maybe it is getting time. Look at the positive convergence on the market catcher on the weekly, sideways moving, improving. So there's some underneath strength occurring in these stocks. And maybe this is a great time to buy. I don't know. Spirit is one that is totally tied to Boeing. If Boeing turns around, this might be a cheap way to play it. So it's now at about an hour. I've gone through the top 10 groups, which is what I like to do. I'm just going to look at footwear because a lot of these look interesting here too. Look at Crocs, sideways in an uptrend, breaking out, mobile breakout from a squeeze, pivot, person, signal, pocket pivots. Kahuna's, Decker's, similar. Under Armour, not yet. Skeechers just broke above the 200. So there's a lot to like in this group. So now let me show you the stocks that I identified between my bottoms up and top down that I'm going to look at potentially playing on Monday if I like the market. That's critical, if I like the market. So the first thing I want to do is change this to a different view so that I could show you industry groups. A number of REITs. Mid-American Apartment. Sideways move, broke out above the 200, had a mobile breakout from a squeeze. It's in a person buy, pocket pivots, Kahuna's, bongo turned green, high jump's not at the very top, the weekly looks good, positive convergence there, positive convergence there. I like Mid-America Apartment Complex, 3.2% dividend yield, great earnings per share growth. All right. Application software, Twilio had a great breakout this week. Something tells me I meant NIU. I don't even know who this is. Uptrend pullback. What I like, breaking out above the trend line. On Thursday, mobile breakout from a squeeze. On Friday, took out its whatever I call it, the chandelier stop. I mentioned some of the regional banks. Chemicals, Lyondell Industries, LYB. Why would I get interest here? Well, my interest here was it's retested on the 200 and the 50. I'd like to see it take out its moving averages. Green candle low, mobile breakout, new person buy, pocket pivot, and a Kahuna. All right. In the building world, Terex, they make some of the stuff for the decks. Broke out above the 200, took out a chandelier stop, mobile breakout from a squeeze. Person buy, Kahuna's. Hgsi I gave you last week. It had a nice breakout this week. Still looks like it can go higher. We talked about Bed Bath Beyond, Home Depot. What about At Home? Pull back to support. I'd set my stop right above that chandelier. Buy stop, mobile breakout from a squeeze. Pocket pivots. New person buy signal. Williams and Sonoma. Sideways move and breaking out off a convergence of the moving averages. Mobile breakout from a squeeze. Person buy, pocket pivot, and Kahuna. Don't I sound like a broken record? A lot of the home builders look good. Here's one that has not gone too far yet. Taylor Morrison, sideways move. Looks like it's ready to break out here. I saw some interest in utilities, defensive play. Here is a bullish engulfing pattern. On Friday, mobile breakout from a squeeze. In a person buy, pocket pivot, Kahuna. 3.1% dividend, the AES Corp. Quidel, I talked about this off the bottom. I talked about it here. I talked about it last week. I'm talking about it again. I think this stock continues to move. Great fundamentals, has a rapid test that combines flu and COVID, 15 minutes or less. I think that you're going to see a lot about that company to come on, a bunch of REITs. I talked about apparels. One specialty pharma. This looked interesting to me. You can see uptrend, pullback, potential breakout here. It took out its chandelier stop this week. The negatives are the weekly bond goes red. I like the pattern. I liked it on TradeStation, which is clicked off. I will tell you that it's got the seasonality. The seasonality is, what's the word I would say, is not good. But that's, fundamentals should trump seasonality. I'll show you the ones that I looked at as my shorting signals. If the market goes up, these are all going to do very well. But they'll give me a sense of how the market's doing by how they do. I mean, you look at something like Applied Materials that failed here at the 50. a breakdown below the 200, I would think this would be a good short. But I also think if the market's strong, it may pop right back up. Look at Amazon, failing at the 50, same story. Does it pull back to the 200? Well, that's why I have puts on it. Those puts are damn expensive. Natura, which have been a leader, rolling over. So these are stocks that I use as sort of a let me know if something's about to happen. Autodesk, I know a lot of you are probably in Autodesk, failed at the 50. So these can go higher if the market does well. I really use them as an early warning signal. On that note, I'm going to say goodbye. Have a great week, and we'll talk to you soon. Thanks, everybody. Safe trades, safe life.